Now, let's start off with Pirate Trails. That's the title of a report by the United Nations Office on Drugs and Crime in conjunction with Interpol, focusing on the proceeds from piracy and associated crimes like demands for ransom. Now, this report indicates that the criminal collected some pretty large sums of money, specifically between $339 million and $413 million in ransoms off the coast of Somalia, somewhere between 2005 and 2012. Keep these figures in mind because the net cost will be pretty large coming off. Now, out of this money, where exactly did it go? Well, anywhere between 30 and 75% of that actually ended up with the core financiers of the Vice, the guys who put up the equity and finance the operations. The foot soldiers, however, made off with a fairly small chunk of that change, just 0.1 percentage points in total. Now, the money, of course, being made by financiers was then used to finance legitimate and criminal activities, and that includes a range of affairs, all the way from trade in cats to arms trafficking, funding militias all over Africa, migrant smuggling and human trafficking as well. Now, to put all of that into perspective, however, then the numbers become way bigger. Piracy costs the global economy $18 billion a year in increased costs of trade. Now, in this case, you're looking at maritime activity, tourist arrivals and fishing yields. All of that dropped significantly along the Horn of Africa and East African nations since 2006. And that's a pretty big level right there. Tawfiq Mushudlu, the chief of the implementation support section of the Organized Crime and Illicit Trafficking branch at the United Nations Office of Drugs and Crime, notes that while the international community may be winning the battle against pirates' foot soldiers at sea, they should be quite wary not to lose the war against criminal kingpins on land. And that's a point shared by Stuart O'Connor, the lead author of this report.
The money that was raised was invested in legitimate as well as illegitimate activities. The legitimate activities such as, for example, hotels, restaurants, the transport sectors, but also in terms of criminal activities such as human trafficking, arms trafficking in terms of funding of militias, as well as money going back into financing further pirate activities. But also we discovered that some of the monies is invested in the cat trade. Cat is a stimulant which is legal in countries like Djibouti, Ethiopia, Kenya, as well as Somalia itself. It goes back more than 100 years, so it's also invested in that. And there is no monitoring, particularly in Kenya.
Over in North Africa, Egypt's stock market closed in positive territory today, despite protest concerns over the starting of the trial of the ousted President Mohamed Morsi in Cairo. The market's main index, the EGX 30, was up 0.5% to 6,222 points. Foreign investors, however, were key sellers, while Egyptians ended the trading session as net buyers. Fairly interesting trends there. Investors have of late become somewhat resilient really to Egypt's political turmoil. That country's economy took a nosedive in the 2011 unrest, and it turned for the worse after the ouster of Mohamed Morsi by Egypt's army in July this year. Key sectors like tourism, construction and of course the Suez Canal are among the worst hit. Market watchers, however, are warning that though the uncertainty in the country needs to come to an end if at all the country is to bounce back to its original form. Let's expand this conversation now into some depth. CCTV's Yasser Kim joins us, and also Mariam Bema. They're live in Cairo and London, respectively, with the latest details here. Yasser, the EGX 30 closing up 0.57% higher. Give us a sense of how the market is reacting to the event, of course, around Mohamed Morsi's trial.
You know, the market usually leads according to the psychology of the businessman and the community and the market at the time. And it seems that there's some kind of immunity from the clashes and all these trials that have been ongoing in the past 2 years. Now they have not had the same effect that it had the first day Mubarak had his trial 2 years ago. The stock market then had fallen drastically. Now they know it will be a limited effect, and therefore the market was not really reacting negatively. It reacted positively with the numbers you just mentioned. And as I've been speaking to experts, they're saying it will even develop more and increase the profits in the next few weeks as we go into other stages of the roadmap. So it seems that the businessmen here are now used to these daily demonstrations, and it's not affecting the market at all.
Indeed, Miriam Yasser there in Cairo talking about the market being insulated from political activity in Egypt. But this is the second president we've seen being prosecuted in that country in just about as many years. What are the odds that we could see the Egyptians' traditional finances in the Gulf states like Qatar, for example, pulling back?
We're actually not seeing that. Very much in agreement with Yasser so far. What's interesting is a common theme among investors not being fazed by recent events as we've seen in the past. Many are actually confident that Egypt can weather the storm as long as there's a definitive timeline for the constitution and a functioning government. Now, Egypt is also doing its part to sustain momentum, holding a conference in December for Gulf businesses and financiers. Analysts see this as a limited opportunity to attract the Gulf states' private sector in line with loans, grants, and petroleum promised by Saudi Arabia, Kuwait, and the UAE. If we see something similar to the pledge of the $12 billion, that will also be a signal, essentially, of stable footing for European investors as well.
Indeed. Yasser, coming back to developments in Egypt, 2 years on, Hosni Mubarak's trial is nowhere near complete. So for how long, really, can this insulation of the market from political events continue?
It's a waiting game, but the waiting cannot go forever. Like just Miriam had just said, the $12 billion coming from the Gulf states and an extra $3 billion from the United Arab Emirates just last week have been helping out sustaining the economy, but this cannot go further unless Egypt starts to produce, starts to get its own income, and this will not happen unless the parliament is put in place, a new president, elected president is put in place, and the security situation gets really tight. That's when investors would go back and invest in Egypt in large numbers, and then we would see the economy going back to growth. But for now, what Egypt is doing is just depending on the loans coming from the Gulf states to sustain it until it's back on the right track for the economy and security in the country.
Finally, Miriam, over the weekend we did see the foreign ministers of Egypt and the United States as well meeting to try and mend relations between these two countries. How closely are those events being followed by investors on your end of the world?
Incredibly closely. You know, some are saying that John Kerry's unannounced visit to Cairo was meant to strengthen political confidence. You know, the U.S. Secretary of State very much confirming that Washington's commitment to reviving the $1.3 billion annual military assistance program, not exactly telling us why or when and how, but investors on this end agree the U.S. will likely step in financially once a new government is in place. The common thought is the U.S. is waiting for Egypt's military and interim government to actually finalize the new constitution and roll it out by December 3rd. Any delays in this would cause more uncertainty and dampen sentiment. The country is capable of, utilizing the funding and aid without sort of corruption. So that's what we really need to see at this point.
Indeed. We'll have to leave it there. Thank you very much for your insights on Egypt's economic pulse. Yasser Hakim in Cairo and Miriam Bemad over in London. Now, away from North Africa, let's take it back to Eastern Africa. Tanzania has categorically stated it will not be party to a joint tourist visa agreement with other members of the East African community, not at least until the relevant fee collection infrastructure has been put in place. Kenya, Uganda and Rwanda are preparing to unveil the visa at the World Travel Market in London ahead of its official launch in January 2014. Tanzania, however, is not on board. Tanzania's Ministry of Natural Resources and Tourism says information and communications technology infrastructure is an important and critical prerequisite to any agreement because it will enable the exchange of fees, data and other information on tourists within the region. Rwanda, Uganda and Kenya believe, however, the visa will help ease the movement of tourists across national borders and make it far easier for industry players to offer multi-destination packages. Now, in 2012, private equity firms invested about $1.13 billion in over 50 deals across sub-Saharan Africa, according to a study by Africa Assets and Deloitte. Now, while that was slightly lower than the total in 2011, the money was flowing into a more diverse spread of sectors, everything really from mining and natural resources to SMEs and consumer-facing businesses. Most of those deals involve amounts less than $20 million in total. So what value really can private equity offer to East Africa's regional family-owned businesses which have grown and expanded mostly out of their own cash and with a healthy aversion to debt and foreign ownership? That's a question I put to Darshan Chandaria, director at the Chandaria Group, a conglomerate that operates across several different markets in East Africa in diverse industries.
We're in a very fortunate position, that we are able to, wherever we want to expand, wherever we want to go into a new venture, we are actually able to put in our reserves almost and fund 100%. So where I do see options like private equity becoming more attractive, apart from, yes, they will bring, they have a huge fund or a huge pool of money to tap into, but the expertise that these professionals bring with them, they've tried and tested, different models in multiple markets. So, and if it's a model, that they're implementing, and to a certain extent, a little bit of local customization that they do in different markets, it's tried and tested, and it works. So I think what they really bring is the expertise, the know-how, and what works and doesn't.
Now, that conversation on the place of private equity and other alternative investment vehicles will be among the topics to be discussed at the Walton Club of Africa's conference in the Kenyan capital, Nairobi, from the 6th of November. CCTV Africa, as usual, will be there for all the latest details. Time for a short break now. Here's what's coming up next. When we come back, we'll tell you how a United Nations embargo failed to stop the illicit production and trafficking of rough diamonds from Cote d'Ivoire.
BizAsia. Asia means business.
Welcome back. An 8-year-old United Nations embargo has failed to stop the illicit production and trafficking of Cote d'Ivoire's rough diamonds. Now, these precious gems are continuously being smuggled out of the West African country, and there are fears that it could be funding the illegal purchase of arms. In an interim report to the Security Council, which monitors compliance with the sanctions on Cote d'Ivoire, the UN plans to investigate a possible network based in South Africa, which is involved in the trade of diamonds between Africa and Asia. Now, the Council started imposing sanctions on the cocoa-producing nation, including an arms embargo, travel bans and asset freezes. It had sent peacekeepers there in 2004 after civil war between 2002 and 2003.
I would say Cote d'Ivoire's government respected the embargo on the diamond, since the country's authorities did not allow the legal exportation of the product in an effective and lawful manner. Cote d'Ivoire did not issue any Kimberley certificate. There was no diamond expertise and no taxes were collected. It should be noted that the embargo, which was imposed by the UN member states, concerns only the import of the Ivorian diamond and not the production. There was a link between the diamond mining, its traders and rebels. That is why it was called the conflict diamonds, and an embargo was placed on it. The people who are currently exploiting the diamonds in Cote d'Ivoire are peasants, and they only earn less than $1 a day. Today, they earn much less than they did before the beginning of the crisis in 2002. According to recommendations, the Kimberley process could state that Cote d'Ivoire abide by the Kimberley process scheme within a month from now.
Now, more than 200 delegates from the African retail industry and, of course, beyond our borders as well, are in South Africa, where they're expected to swap experiences from right across the continent. Areas of focus at the conference include spotting new markets, with case studies zeroing in on South Africa, Kenya, Nigeria and Egypt. South African retailers like Pick n Pay and ShopRite increasingly looking to the rest of Africa to boost their bottom line, as growth is far higher than they're seeing at the moment in South Africa. Expansion, however, has come with its challenges. The most recent case is where, planned by Walmart through its South African subsidiary Massmart, failed to buy a majority stake in Kenya's retailer Naivas. After months and months of talks, Naivas turned around and said they're no longer interested in the deal, ostensibly in order to grow the even further. CCTV Sumitra Naidu joins us now live from Johannesburg, South Africa, with the latest details, of course, on the conference and the key issues being discussed on that end of the world. Sumitra, the bulk of Africa's population really is under 20, highly connected. How does this change the face of retail as far as operating in Africa is concerned?
That's right, Rama, and this was one of the issues that was raised at the World Retail Congress today. How retailers have to and need to, in a very speedily fashion, adapt to serve a growing young population. Online retail is very low in Africa compared to other international countries. South Africa, for instance, is heading up some of these African countries, but the e-commerce market is still small. But it is growing. We saw a gain of between 30 and 35% last year, which is a fair gain. And the gains we are seeing in South Africa is also spreading across the continent. More young Africans are becoming tech savvy, and therefore their demands are growing. And it's here that retailers need to invest heavily in online strategies, IT infrastructure, skills training in order to deliver their products on different platforms, making the customer experience simpler and more efficient.
Now, in East Africa, we've seen overtures either for an outright takeover and equity buy-in being completely rebuffed, all the way from Naivas on to Nakamas. What sort of alternative entry points are being considered at the conference?
Yeah, well, this is a tough one. I spoke to a few retailers and entrepreneurs, and they feel that more work needs to be done with government. So you have private sector and governments working together. It's really a matter of making the environment more conducive for smaller entrepreneurs and the bigger retailers locally and international retailers that are keen to enter the African market. This, they say, will provide healthy competition and, of course, more choice for the retailer, for the consumer rather. It's a matter of governments realizing that there's such a strong demand and a rapidly growing population on the continent, and there's place for everyone. So it's really about cutting down the bureaucracy and really making the legislative framework more investor friendly at this point.
Indeed. Thank you very much for that. That's CCTV's Sumitra Naidu live in Johannesburg, South Africa, with the latest, of course, on the retail conference. Now, quick run through the markets for you. Broad spread of green numbers across the board so far. Starting, of course, as usually do in Nigeria. The all-share index up by a fraction and a half a percentage point. The all-share index in South Africa also in the green, up by just under a quarter. The 20-share index in the Kenyan capital, Nairobi, putting in some incremental gains, still not quite at the 5,000-point mark on the 20-share index. And Egypt, of course, in the green, regardless of the trial of Mohamed Morsi and the political tensions around that, ending the day higher by half a percentage point.